If everyone owes money, who do they owe it to? That sounds like a simple question, but when you actually try to answer it, when you pull at that thread, the entire financial system starts to unravel in front of you, because the answer reveals something most people never think about. Debt is not what you think it is, and the people collecting interest on all this global debt, they are not who you expect. Right now, global debt sits at around $305 trillion. Governments owe $36 trillion in the United States alone. Europe, Asia, emerging markets, every country on the planet is buried in debt. And citizens look at that number and think, okay, we borrowed this money, so someone lent it to us? Someone is holding our IOUs, someone expects to be repaid. But here is where it gets strange. When you ask who the creditor is, who actually holds all this debt, the answers do not add up. Japan owns about $1 trillion of U.S. debt. China owns $768 billion. The UK, private investors, pension funds, they all own pieces. Add it all together and you still cannot account for most of it. Because the largest single holder of government debt is not a foreign country. It is not a pension fund or a bank. It is the central bank. The Federal Reserve holds $4.5 trillion of U.S. debt. The European Central Bank holds trillions in European government bonds. The Bank of Japan holds even more. And here is the truly bizarre part. When the government pays interest to the central bank, that money gets sent right back to the government as central bank profit. The government is paying itself with money it does not have, that it borrowed from itself, using a system where more debt exists than actual money in circulation. This video is about one idea. Debt is not a loan that gets repaid. It is a system designed to be permanent, and the creditors are not waiting to be paid back. They're collecting interest on money that was created out of nothing, and the system is built so the debt never goes away. I am the debt archivist. My job is to dig through old files to find the patterns your news never explains. Today we are opening the file on perpetual debt, the system where everyone owes money and somehow no one is really the creditor. Let me take you back to 1794. Britain had just finished fighting France in a series of wars that nearly bankrupted the country. The debt was enormous. The government needed money, but British citizens did not have enough savings to lend. Foreign creditors were unreliable. So Britain did something revolutionary. They created the Bank of England in 1694 as a private institution with a very specific job: lend money to the government. The government would issue bonds. The Bank of England would buy them, and in exchange, the bank got the exclusive right to issue currency. Essentially, the bank lent the government money that the bank created by writing numbers in a ledger. This was not a traditional loan. The government was not expected to actually pay it all back. Instead, they would pay interest forever. The debt would roll over. New bonds would replace old bonds. The arrangement was designed to be perpetual, and here is what made it brilliant from the bank's perspective. The interest payments came from taxes. The government would tax its citizens, and that tax revenue would flow to the Bank of England as interest, steady, predictable, permanent. For the government, this solved an immediate problem. They could fight wars, build infrastructure, fund the empire without needing to find lenders every single time. The debt was always there. The bank was always ready to buy more bonds. The system became self-sustaining. By 1815, after the Napoleonic Wars, British government debt had exploded to over 250% of GDP. That is not a typo. Debt was 2.5 times larger than the entire economy. If this were a household, it would be catastrophic. But Britain did not collapse. They did not default. They just kept paying interest. Here is how they pulled it off. The Bank of England kept buying bonds. The British pound was backed by gold, which gave it credibility. And the interest rates stayed low because investors trusted that Britain would always pay. Not pay off the debt, just pay the interest. Over the next century, Britain slowly reduced the debt ratio, not by paying it down, but by growing the economy faster than the debt grew. By 1914, debt was down to around 30% of GDP. But then World War I hit. Debt exploded again. By 1918, debt was back up to 140% of GDP. Again, Britain did not pay it off. They restructured. They refinanced. They let inflation erode the real value. The pattern repeated. Debt surged during crises. It shrank during growth periods, but it never disappeared. The system that Britain pioneered became the model for the entire world. Permanent debt. Central banks as the buyer of last resort. Interest paid forever. Principal rolled over indefinitely. And the key insight here: the Bank of England was not really a creditor in the traditional sense. Yes, they held government bonds, but they were also issuing the currency. They were part of the same system. When the government paid interest to the bank and the bank sent profits back to the treasury, it was a closed loop. The money was moving in circles. This is the origin of the perpetual debt system. A system where the debt is not meant to be repaid. It is meant to exist forever, generating interest payments that flow to bondholders, which increasingly include the central bank itself. Now let me show you how this same pattern played out twice in the 20th century with two very different outcomes. Britain in 1945 and Japan in 1990. Both faced massive debt. Both had central banks buying government bonds, but one escaped the trap relatively smoothly. The other is still stuck in it 80 years later. After World War II, Britain owed more than 250% of GDP again. The empire was crumbling. The economy was shattered. The pound was overvalued. Britain had massive obligations and almost no way to pay. But here is what Britain had going for it: governance credibility. Investors believed the British government would manage the debt responsibly over time, so bond yields stayed relatively low. Britain did not face a sudden crisis. They had time. Britain used that time wisely. They let inflation run higher than usual, which eroded the real value of the debt. They grew the economy steadily for decades. They restructured obligations. And crucially, the Bank of England kept interest rates low, which kept debt service costs manageable. By 1970, British debt had fallen to around 50% of GDP, not because they paid it off, because growth and inflation shrank it relative to the economy. Now compare that to Japan. In 1990, after decades of rapid growth, Japan hit a wall. The real estate bubble popped. The stock market crashed. Banks were insolvent. The government stepped in with massive stimulus. Debt exploded. By 2000, Japanese government debt was over 100% of GDP. By 2010, 180%. By 2020, over 250%. The highest peacetime debt of any major country in history. And here is the key difference: Japan never let inflation rise. They fought deflation for decades. Without inflation, the debt could not be eroded. Growth stayed anemic. The debt kept piling up. But Japan did not collapse. Why? Because the Bank of Japan kept buying government bonds, trillions and trillions of yen worth. By 2024, the Bank of Japan owned nearly half of all Japanese government debt. The central bank had become the primary creditor. And just like in 18th century Britain, when the Japanese government pays interest to the Bank of Japan, that money flows back to the government as central bank profit. It is a closed loop. So here's the comparison. Britain in 1945 and Japan in 1990 both faced the same problem: debt far exceeding GDP. Britain used inflation and growth to escape. Japan used central bank debt monetization to endure. Both systems rely on the same principle. The debt does not get repaid, it gets managed. And the central bank acts as the shock absorber, the permanent creditor who never demands full repayment. The difference is psychological. Britain believed they could grow out of it, and that belief helped them actually do it. Japan accepted that growth was slow, and that acceptance locked them into perpetual stagnation. But both prove the same point. In the modern debt system, the creditor is not external. The creditor is the system itself. If you strip away the details, the pattern of perpetual debt looks like this. Stage 1. Cheap money and easy debt. This is where we are right now in 2025. Interest rates have been historically low for over a decade. Governments can borrow cheaply. Deficits do not feel urgent because debt service costs are manageable. During this stage, everyone assumes debt is sustainable. Politicians promise more spending. Voters demand more services. No one seriously proposes paying down the debt because why would you? Borrowing is easy. Stage 2, everyone calls it sustainable. Economists create models showing that debt to GDP ratios can stay high indefinitely as long as growth outpaces interest rates. Central banks assure the public that they have tools to manage any crisis. Credit rating agencies maintain high ratings. The consensus is, this is fine. The logic is, if the government can roll over debt forever, And if the central bank is always willing to buy bonds, then the debt level does not matter. What matters is the interest rate. And as long as the central bank keeps rates low, the interest is manageable. This stage can last a very long time, decades even. Japan has been in this stage since the 1990s. The U.S. has been in this stage since 2008. Stage 3. First cracks appear. Something changes. Maybe inflation spikes, forcing the central bank to raise interest rates. Maybe a recession hits, causing tax revenues to drop while spending increases. Maybe foreign creditors start demanding higher yields. Whatever the trigger, the cost of servicing the debt starts rising faster than revenue. Suddenly, interest payments eat up a larger and larger share of the budget. Other programs get squeezed. Deficits widen even faster. This is where we are starting to see cracks now. U.S. interest payments hit $1 trillion in 2024. That is more than the defense budget. The Congressional Budget Office projects interest costs will reach $1.8 trillion within 10 years. That is not sustainable. Stage 4, authorities double down. When cracks appear, the instinct is not to fix the underlying problem. The instinct is to borrow more to cover the gap. Governments issue more debt. Central banks buy more bonds. The logic is, we have always managed this before. We can manage it again. This is where central banks shift from being neutral managers of monetary policy to being active financiers of government spending. The lines between fiscal and monetary policy blur. Quantitative easing becomes permanent. The central bank balance sheet never shrinks back to normal. During this stage, the debt accelerates, but crises are postponed. Markets stay calm because the central bank is signaling it will do whatever it takes. This can also last years. Stage 5. Confidence breaks. Eventually something snaps. Maybe inflation gets out of control, destroying the currency. Maybe foreign investors lose faith and sell their bonds. Maybe domestic savers realize the government cannot actually repay them and start pulling money out. Once confidence breaks, the game is over. Bond yields spike. Refinancing becomes impossible. The government faces a choice: default on the debt or print money to pay it off, which causes hyperinflation. This is what happened to Argentina in 2001, Greece in 2012, the Soviet Union in 1991. When confidence evaporates, the debt trap closes fast. Stage 6, forced reset. The final stage is restructuring. The government negotiates with creditors to take a haircut. Bondholders get back 30 cents on the dollar or 50 cents or whatever is negotiated. The debt is written down, the system resets, or in extreme cases, the currency collapses entirely. Hyperinflation wipes out the debt in real terms, but also wipes out savings, pensions, and the entire economy. The pattern is the same every time. Easy debt leads to complacency. Complacency leads to overborrowing. Overborrowing leads to fragility. Fragility leads to crisis. Crisis leads to reset. And here is the critical insight. During stages 1 through 4, the central bank is the enabler. They buy the bonds, they keep rates low, they tell markets everything is fine. But when stage 5 hits, the central bank cannot stop it. They become part of the collateral damage. Now let me explain the psychology of the actors in this system, because this is not just about math, it is about incentives and self-deception. First, politicians. Their incentive is to get re-elected, and voters reward spending, not fiscal discipline. If a politician proposes cutting programs to pay down debt, they lose votes. If they propose raising taxes to reduce deficits, they lose votes. The only politically safe move is to borrow and spend. Politicians tell themselves a story. We are investing in the future. This infrastructure project will pay for itself. This stimulus will grow the economy. The debt is manageable because we can always refinance. And for a long time, that story works. Because the central bank keeps rates low, debt service stays affordable. The crisis never comes. So why stop? Second, central bankers, their official mandate is price stability and full employment. But they also face political pressure to keep the government functioning. If bond yields spike and the government cannot refinance, that is a financial crisis. And central banks are supposed to prevent financial crises. So, central bankers convince themselves that buying government bonds is not monetizing the debt. It is just managing liquidity. It is temporary. It is reversible. The fact that the balance sheet never actually shrinks back, that is just because economic conditions require ongoing support. Central bankers also face a coordination problem. If they stop buying bonds, who will? If they let yields rise, will it trigger a debt crisis? The safer move is to keep buying. The risk is always in stopping, not in continuing. Third, the public. Most people do not understand how debt works. They hear the number 36 trillion and think that is a lot. But they also see that nothing bad has happened yet. The government still functions. Social Security checks still arrive. Life goes on. So, the public normalizes it. High debt becomes the new normal. Deficits become the new normal. Central bank bond buying becomes the new normal. The alarm bells stop ringing because everyone gets used to the noise. And there is another psychological factor, recency bias. The last major debt crisis in a developed country was Greece in 2012. But Greece was small. It was poorly managed. The U.S. is different. Japan is different. We have strong institutions. We have the reserve currency. It cannot happen here. That belief, that exceptionalism, is exactly what every empire has believed right before the system broke. So let me connect this to where we are right now in 2025. The United States government owes $36 trillion. That is 120% of GDP. Interest payments reached $1 trillion in 2024. The Congressional Budget Office projects the debt will hit $50 trillion by 2035. Here is who owns that debt. The Federal Reserve holds $4.5 trillion. Foreign governments and investors hold about $9 trillion, with Japan and the UK as the largest holders. Domestic investors, pension funds, mutual funds, insurance companies hold another chunk, and the rest is held by other government accounts like Social Security. Now, when the government pays interest on that debt, where does the money go? Some of it goes to foreign creditors, some goes to pension funds and private investors, but a huge portion goes to the Federal Reserve. And the Federal Reserve is required by law to send its profits back to the Treasury. So the government is paying interest to the Fed, and the Fed is sending that money back to the government. It is a closed loop. Except for one problem. The Fed also pays interest on reserves to banks. So the money flows to banks as well. In 2024, the Fed actually lost money for the first time in decades. They were paying more in interest on reserves than they were earning on the bonds they held, so instead of sending profits to the Treasury, they suspended payments. The government lost a revenue source, right, when debt service costs were spiking. This is the trap. The central bank bought bonds to keep rates low and support the government. But now, to fight inflation, they have to raise rates. And raising rates increases the Fed's own costs, which reduces the money they can send back to the government, which increases the deficit, which requires more borrowing. It is a doom loop, and we are in the early stages of it. Now look at who benefits from this system. The largest beneficiaries are not mysterious foreign powers. They are institutional investors, pension funds managing trillions, hedge funds leveraging short-term positions, insurance companies holding bonds as safe assets. These institutions profit from the steady stream of interest payments. And because the central bank keeps buying bonds, the prices stay elevated. Investors can sell their bonds at a profit. The system rewards holding government debt. But here is the darker side. The biggest winners are those who already have capital. If you have $1 million, you can buy bonds and collect interest. If you have $10 million, you collect even more. The debt system transfers wealth from taxpayers, who fund the interest payments through taxes, to bondholders, who collect the interest. And the truly wealthy, they use leverage. Hedge funds borrow at low rates to buy bonds, amplifying their returns. This is why the Bank for International Settlements warned in 2024 that non-bank financial institutions are increasingly dominating sovereign bond markets with highly leveraged, short-term positions. The system creates a class of permanent creditors who profit from the debt, while the burden of repayment, or in reality, the burden of perpetual interest payments, falls on ordinary citizens through taxes and inflation. So what does this mean for you? How does understanding this system change anything? First, stop thinking of national debt as something that will be repaid. It will not. The debt is permanent. The question is not if it will be paid down. The question is, how will the interest be serviced and at what cost? Second, recognize that the creditor is not external. Most of the debt is held domestically or by central banks. The U.S. owes money primarily to itself. This is not like a household borrowing from a bank. It is more like a family that created its own bank, and that bank is lending to the family, and the family is paying interest to the bank, which is owned by the family. It is circular, and that circularity is what allows the system to persist far longer than simple math would suggest. Third, understand that inflation is the escape valve. When debt gets too high, governments have two options: default or inflate. Defaulting destroys the financial system. Inflating erodes the debt gradually while also eroding savings. So if you see persistent inflation over the next decade, it is not an accident. It is how governments manage unsustainable debt without formally defaulting. Fourth, know that the central bank is not neutral. They claim to be independent. They claim to manage monetary policy for the benefit of the economy. But when push comes to shove, they buy government bonds. They keep the system running. They are the lender of last resort, not just for banks, but for the government itself. This means monetary policy and fiscal policy are inseparable. The central bank enables the debt. The government depends on the central bank. They are two parts of the same machine. And finally, understand that this system is fragile. It works as long as confidence holds, as long as investors believe the government can service the debt, as long as the central bank can keep rates low without triggering inflation. But if any of those assumptions break, the system unravels fast. We saw it in Greece. We saw it in Argentina. We saw it in the Soviet Union. The collapse is not gradual. It is sudden. One day, the bond market is calm. The next day, yields are spiking and refinancing is impossible. You cannot control government debt, but you can control how you think about it. You can stop treating the dollar or the euro or the pound as something untouchable. It is just another asset. And like any asset, it can lose value. Understanding the debt system does not give you a crystal ball, but it gives you a framework. You know that debt will not be repaid. You know inflation is likely. You know the central bank will keep buying bonds until they cannot. And you know that when confidence breaks, it breaks fast. That knowledge is an advantage. Most people will be surprised when the reset comes. You will not be. The archive does not predict the future. It shows you the sequence we are already in. If you want more calm, no-nonsense breakdowns of how debt, empires, and currencies really behave, subscribe to the Debt Archive. Because once you see the pattern, you cannot unsee it.